about economics. I'm here to learn about how much money I can make. If you are here to learn that, get out. Now, if you feel that you have passion for the financial markets, then let's keep talking, okay? Fundamental analysis is a very broad topic, so it includes a lot of things inside. To learn fundamental analysis properly, you need to learn macroeconomics. So if you have watched my economics video that I've made, economics is divided into two types, right? Number one is microeconomics, which you can for now ignore what drives each of the currencies. Because different currencies have different drivers, different main drivers. They might be all driven by the same thing, but there are certain factors that drive certain currencies. For example, a high yield currency like Aussie dollar. Okay, one of the drivers for Aussie dollar is gold prices and also iron ore prices. Another example, Canadian dollar. What drives Canadian dollar? So one of the major trading partners of Canada is United States, and hence the United States economy is going to tremendously affect Canada. And hence, if you are trading Canadian dollar in the long term, you need to look at what's happening in the US. And also Canadian dollar is driven by oil prices. So realize how different the main drivers are. They might be both driven by global GDP rates, but they each have their own drivers. You also need to learn international trade. How does a trade surplus influence a country's currency? How does a trade deficit influence a country's currency? Next thing you need to learn, just like how Starbucks have their own language. Yes. What's the difference between nominal GDP, real GDP? What's the difference between normal inflation and core inflation? What's the difference between trade deficit and trade surplus? All these things you need to know. You can also classify FA into sentiment analysis. How are traders feeling right now? It's very important. You need to know that. And also, you need to be able to learn intermarket analysis. What's the correlation between currency market and bond market? What's the correlation between stock market and bond markets? What's the correlation between Aussie dollar, Canadian dollar during an economic boom? So the third thing you need to learn is economic indicators. There are lots of economic indicators out there, but you don't need to learn everything. You just need to learn which are the more significant ones. Doesn't matter if it's a leading, lagging, coincident indicator, you gotta learn all these three. Example, you gotta learn GDP, CPI, PPI. You gotta learn about money supply. You gotta learn about balance of payments, manufacturing, and non-manufacturing data. Or some people call it services, PMI, consumer sentiment, employment, unemployment data, or in other words, labor data. You also need to learn about housing data, which includes things like building permits, housing starts, and also other economic indicators like durable goods order. One very important thing, learn what makes an economic indicator strong. For example, when there's an economic boom, when inflation is high, a lot of people, they are going to focus more on inflation data, CPI, PPI. But when there's a recession, this would not be much of a focus. It will still be a focus, but not be as much as compared to during an economic boom. During a recession, people are going to focus more on employment data. Another example, number of revisions. Because for example, GDP, you have advanced data, prelim data, final data. Which one is more important? The first release, advanced GDP, it is released first, and hence people are going to focus more on that. Whereas for prelim GDP, final GDP, because it is revised again and again, markets are not going to focus that much on that. A lot of retail traders get this wrong. They think that certain indicators are indicators that tell them what's going to happen in the future. So you need to learn which are the indicators that predict what's going to happen in the future, which are leading indicators. You need to learn which are the indicators that tell you what is happening right now, which are coincident indicators. You need to learn which are the indicators that tell you what happened in the past. You also need to know what are the central banks looking at. For example, if you look at CPI, central banks focus on core inflation, which is an adjusted number. Not my problem. This means that if you look at economic numbers, don't take the numbers as it is. Don't believe every single number that you see. Don't believe. Talking head in the news, they tell you, okay, this stock is gonna go up, this currency is gonna go up. First thing first, they are paid to give you that recommendation. Second thing is that they can tell to buy something. At the back end, they are selling the whoever says that, whether forecast always has to be correct. So my point here is that don't use actual numbers to make your trading decision alone. You can use it as a confirmation to your overall analysis, but don't use that number alone to trade, because a lot of times you realize that numbers can come out as positive, but the asset, the currency can still go down. Of course, due to many reasons, it's due to percentage changes, expectations that matters most. So the next thing, you gotta think like an economist. So how do you train yourself to behave like an economist? First thing first, you need to understand that the key markets that are affected by economic indicators include bond market, currency market, stock market. If you're looking at a certain number today, you need to ask yourself a couple of questions. Which currency or which market is going to present to you the best profit opportunity? Second thing, NFP number is gonna come out tonight. Before the number even comes out, few days before, 1 week before, 1 month before, you need to make your own prediction. Based on my analysis, it's gonna be higher or lower than expected. So in other words, you gotta so-called predict, okay, no one can predict, but you gotta come up with that number in your head yourself and see how far you are from the actual numbers. And if your prediction is very close to the actual numbers, and you're gonna determine beforehand if the number comes out as positive or negative or the same, how will markets react to it? And also based on your prediction, determine how far off are you from the consensus range. Now, why is it so important for you to do this? Because in order for you to train yourself in anything, you gotta get your hands dirty and do it. You cannot just sit back and wait for somebody to send you a signal and wait for somebody to donate you money into your Forex account, because that is not gonna happen. If all you're doing is absorbing information, you're not trying things out, you're not failing, no matter what kind of strategy you learn, your trading is not going to improve. Now, if you want to learn